Welcome to Deal Dialogue.
Hello and welcome to Deal Dialogue, a discussion on all things related to M&A and financing. In this segment, our topic will address how private companies typically get sold. I'm Rob Hickey with RBC Mid-Market M&A. Joining me today is our production engineer, Tarek Chami, and Jeff Tone, a director on RBC's Mid-Market M&A team. Jeff, thank you for taking the time to join us.
Thanks for having me.
Private company M&A, selling of businesses, this is a topic we hear a lot about. If you look at the statistics or read the news, it seems like there are quite a few companies getting sold. How do these deals happen? Is there a listing process or a marketplace?
You're correct, Rob. In fact, we've seen a year-over-year growth in the number of businesses sold since 2016. In 2018, which is the best year on record, there were over 1,400 businesses sold in Canada with enterprise value up to $150 million, which is loosely considered to be the ceiling of the mid-market here in Canada. 2018 was up almost 22% over 2017. So far, 2019 is outperforming 2018 at the end of Q2. Unlike real estate, there is no formal organized marketplace for the sale of businesses. A business is not like a house. It's much more complex, and as a result, the sale process is much more fluid, intensive, and time-consuming. It's difficult to find two similar businesses, unlike finding two houses that could be very much the same. In order to maximize the value of a business, a story must be built and articulated to potential buyers. Typical areas highlighted to potential buyers include the management team's strength, near and long-term growth opportunities, customer diversification, and competitive advantages like internally developed IP and processes.
Jeff, we hear there is a lot of money out there chasing deals and a lot of companies that are being called on by advisors, by private equity firms, and so on. Should sellers just wait for the phone to ring?
Well, there have been business owners that have been successful selling their businesses after picking up the phone. We caution business owners against this. We've all read or heard about the stories of bidding wars for houses in various parts of the city. The sellers in this case know with certainty that they've received the highest value from the market because multiple buyers were negotiating to purchase the house. Similarly, if a business owner opts out of a competitive process, how will she or he know if they really receive the highest value? In addition, as mentioned earlier, the sale of a business is much more complex than the sale of a house. In addition to maximizing value, which is typically the most important thing for a seller of a home, business owners are often concerned with other important items, including, for example, working capital targets, holdback amounts, reps and warrants insurance, and etc. Without running a full, professional, and robust process, it's difficult to achieve the best outcome.
Better to be proactive and approach the market than wait to be approached. You know, I talked to a number of business owners who say, well, there's only 2 or 3 people that would be interested in our company. Should a business owner or a seller just pick a few names or parties they're interested in and approach them directly?
Without doubt, it's most ideal to approach the market versus waiting to be approached. As we've touched on already, the benefits of running a process are numerous. We have had clients in the past try and run the process themselves, selecting one or a few competitors and seeing if a transaction can be completed. This approach, in our view, and certainly my view, is fraught with challenges, including 1, not achieving the highest value, 2, risking that the terms will change later in the process once the seller is invested, and finally, the increased chance that the negotiations will become public, potentially causing issues with employees and customers around breach of confidentiality. What sellers need to understand is that selling or buying a business is not a straightforward process, and that a seller attempting to do it on their own is at a very significant disadvantage from a skills perspective, not to mention that they are also personally attached to the business, which can often cloud their judgment. Buyers often have the best accountants, lawyers, and other advisors that money can buy. The only way to level the playing field is retaining advisors that spends all of their time dedicated to selling businesses, dealing with those very same buyers, but from an equal footing in terms of knowledge and experience. The advisor understands very well the fluidity of the process and the type of story that needs to be told to get buyers excited about the opportunity. Finally, the business owner that attempts to sell the business on their own runs a huge risk that the business will suffer while their efforts are focused on a transaction. Hiring an advisor, on the other hand, allows the seller to continue to build value while letting a professional run the sale process.
Who are the likely buyers for businesses, assuming that the owner has canvassed family and the next generation or management don't want to or are unable to take over?
Well, there's generally two types of buyers out there today, one being strategic and two being financial buyers. Strategic buyers are generally, buyers that are in the industry, likely a competitor. In the past, strategic buyers have often been thought of as the buyer that could pay the most, generally because they're in the business and can likely achieve synergies post-sale. Financial buyers include private equity and family office. Investors in private equity are often pension plans, insurance companies, banks, and high net worth individuals that are attracted to the superior returns that can be generated, often in excess of 20%. Family offices, on the other hand, are generally comprised of ultra high net worth families or individuals that invest their own capital to generate these high returns. Private equity is built on a fund model, so their timelines are generally shorter and the fund has a predetermined life, in most cases 5 to 7 years, whereas family offices are not constrained by predetermined fund lives and can be more patient in their holding period. One of the greatest distinctions in my mind between the two types of buyers is that strategics almost always buy 100%, whereas private equity are partnering, if you will, with the seller and the management team to facilitate business growth and ultimately build value that will be realized in 5 to 7 years or sooner. It was not too long ago that strategics were almost always able to outbid the private equity groups. In recent years, however, that has changed as the private equity pool of buyers are able to match, in some cases, outbid strategics. There are three primary reasons for this. One, private equity has built a reputation of providing their investors with superior investment returns, which has resulted in a flood of capital pouring into private equity firms. Right now, there is over $1 trillion across the United States and Europe that goes uninvested, or what we would call dry powder. Two, the excessive amounts of capital need to be deployed, and as a result, the private equity firms are aggressive in terms of their valuations. Finally, as private equity has been so active, they have made or want to make investments in particular industries, whether that's tech, healthcare, or distribution, which we would call platforms. If a private equity firm is looking to make its first acquisition in a particular industry, it will be forced to compete against strategics to be the winning bidder.
You're listening to Deal Dialogue.
Talk about different processes. You've talked about the type of buyers. Now, we started this conversation and the topic is really around the processes or processes here in Canada. So what are the pros and cons of each, and help us understand that and the impacts to the potential seller?
Yeah, sure. We offer a highly customized approach to every business that we are retained to sell. As I've said before, there are no two businesses alike. Therefore, the process should be one that fits the situation. At the outset, we must determine the objectives of our client, and based on our findings, we'll tweak our process. In some cases, we'll conduct a broad-based process where all buyers receive the information and are asked to participate. In other cases, we may have determined that there's a smaller group of the best buyers, and we'll target that group looking for feedback before sending the information off to the less strategic buyers. Once again, it's situational dependent. One critical area of importance for our clients, though, is maintaining confidentiality throughout the process. We achieve this by 1, having all receiving parties sign an NDA, and 2, running a structured process with firm timelines, which then reduces the amount of time the business is actually in the market. And finally, working with a reputable advisor that has a reputation for working on quality mandates prevents breaches in confidentiality, as buyers as a whole do not want to risk being left out of future opportunities because of a breach in confidentiality. For example, let's assume the seller is in his or her early 40s and has built a very successful high-growth company, but the owner feels that they will not be able to take it to the next level. Based on this, it's clear that our targeted buyers would be private equity or family offices, as the owner is looking for a partner. The opposite would be an owner in his or her late 50s or more that has run out of gas, if you will, and wants to transition out of the business in an orderly fashion. Our targeted buyer group would be strategics and private equity that may have a platform already and is looking to make add-on acquisitions.
As you're going through this process, what kind of information is being shared with buyers?
The initial piece of information is really a one-page, no-name descriptor of the company that provides select summary financial data and business highlights. Accompanying this one-pager is a non-disclosure agreement that must be executed and returned back before the confidential information memorandum, or what we call a SIM, is provided to the interested buyer. The SIM is a comprehensive presentation of the business that highlights the opportunity and its value attributes. It also provides a detailed overview of the historical financial results, as well as a forecast for the next 3 to 5 years. Areas of highlight typically include an overview of the company's history, milestones, products, services, its management team, customers, suppliers, and obviously the growth opportunities.
We've developed an approach to the market. We have put some documents together that we plan on taking out to a list of buyers. How do you go about developing that list?
Creating that list is a very research-intensive process. While we are building the SIM, we're also building our understanding of the business and the opportunity that will help us refine our buyer search. Depending on the situation, we'll most likely look into both strategics and private equity. Strategics are easily found through looking at public comps and just general market data. Private equity buyers are vetted by their investment focus and preferred transaction size. We use numerous databases for that exercise. More importantly, RBC has a very strong brand in the marketplace, so we have a great deal of inbound inquiries resulting from that. Finally, RBC's capital markets platform can provide introductions to both strategics and private equity.
When you're looking at these buyers, how do you evaluate whether they have the means to actually get a deal done?
We have a pretty good idea as to the buyer's financial and operational ability to conclude a transaction based on past dealings or review of public filings in cases where we're dealing with a strategic. Where we not have a good sense early on in the process, we will look for signs that might signal the buyer may not be able to complete a transaction. That would include not meeting deadlines, perhaps changing key terms along the way.
How do you get them excited and interested in a transaction?
It really begins with that one pager. That's the key to getting parties interested. Highlighting the uniqueness of the opportunity and its value attributes is usually enough to get the party interested. Augmenting this, we will engage in one-on-one phone discussions with prospects if we've not heard from that party, and in those conversations, we'll highlight why the buyer should be interested in the opportunity.
As you're in the market and having conversations with buyers, when does the topic of price come up? Do you go out with a listed price, or how does that work? And how do you get an auction going?
That's a great question. We do not put a price on the business. We expect that the buyer will provide us a view on value based on the review of the information that we've provided to them. It's critical to understand that the value of a business will be different to every buyer looking at it. Factors like synergies, future growth plans, competitive factors will drive different value conclusions. An auction-like setting is created by maintaining tight deadlines and milestones throughout the process. Engaging a reputable firm also sends a signal to buyers they are just one of many credible buyers in the process, and therefore it's going to be competitive.
Many business owners will say they have people talking to them and the potential buyer doesn't like auctions. When you hear that, what goes through your mind?
Right away, it just suggests that buyer's not going to be competitive in price. They don't want to be involved in a process because they're going to have to pay full market value for the business. So we would probably not want to deal with a buyer like that, or at least include them and make them understand that they're going to be in a process.
You're listening to Deal Dialogue.
When you're running a process, if a buyer steps forward and says, look, I really want to buy this, I don't want anyone else to have it, can we short circuit the process? How do you respond to something like that?
Generally, again, to extract the best value for our clients, we would suggest that we treat that buyer just like every other buyer. If they like the business today, they're going to like it tomorrow, whether or not they're in the process or not.
How do you ultimately decide on a buyer?
The buyer that can ultimately check the boxes, if you will, for the seller is often the successful bidder. Value, in most cases, is very important for our clients, but there are other factors as well that are very important. Things like the structure, the transition time, and the involvement of the owner post-close are other areas of importance for sellers. Some buyers will be in a position to address more than others, and that allows the seller to select the best buyer.
We've talked a lot about the M&A advisor's role. Obviously, these processes are complex and involve a number of different parties. What does a typical deal team look like for a seller?
A successful transaction relies on a strong, cohesive group of advisors. Leading the group is the M&A advisor and their team that manages the process and directs the support advisors, in this case, the accounting and legal, and they will add their specific expertise on an as-needed basis.
And I guess as well, wealth advisors and commercial account managers might be part of the team.
Absolutely, as they are a very strong advisor to their clients.
There's obviously a lot to running these processes. In terms of timing, what does a typical timeline look like?
We advise our clients to kind of be prepared for 7 to 9 months, ideally. However, it can stretch to 12 months, just depending on what happens during the process itself. But it's again, it's really situation specific. But in all cases, certainly, we strive to minimize the time that the process will take.
What kind of fees do clients need to think about? Investment banking fees and others?
Well, from an investment banking standpoint, a reputable advisor will charge the vast majority of their fee on the back end upon success. Our fees are calculated as a percentage of proceeds received by the seller. So as the purchase price increases, the relative percentage will go down. Certainly one thing to remember is that advisors' interests should be aligned with their clients. And what I mean by that is that they shouldn't be earning any fees before the success has been determined by really a successful close.
What other kinds of fees would a typical client incur in the process of selling their business?
Well, clients certainly should be prepared that there's going to be certainly legal fees as their counsel is going to take them through the legal part of the process. There's going to be some additional tax fees, likely from their accountants, maybe tax lawyers, and some fairly general or minimal accounting fees.
Obviously, investment banking fees, even though they're a percentage and paid at close, can be relatively significant. How do you ask clients to look at fees in terms of the cost versus the value?
There's a couple of answers to that, and one is that we know that the process is going to yield the very best results in terms of value and structure and the things that are important to a client. And also, time is important to our clients, and they need to be focused on growing value in the business versus being distracted by doing it themselves. So I think those two alone would justify certainly our fee.
We've obviously had a pretty comprehensive discussion here around sales processes. Maybe, Jeff, could you summarize in a few bullet points your thoughts around this topic?
Yeah, sure. Point number one would be, sellers are often very outskilled on a sale as they do not have the experience that buyers do. 2, how else does a seller be content that they've received the absolute best deal without a full market process or exposure? 3, sellers should be focusing on driving growth in the business in parallel to a process to ensure the best deal results are achieved. And finally, sellers generally get one chance at this, and the business is most likely the largest asset they have. So it's vital to doing it right, as there are no mulligans in this game.
No mulligans. Well, on that note, Jeff, we'll wrap this up.
Thanks, Rob.
That's it for this segment of Deal Dialogue. I'm Rob Hickey, and thank you for listening, and good luck with your deals. Deal Dialogue is a production of RBC Mid-Market M&A. Our production engineer for this segment is Tarek Chami.